The illness has exposed our financial fragility. An orgy of borrowing, speculation, and euphoria has left the markets on the verge of a catastrophe. Financial markets have experienced the fastest ever crash over the past few weeks, and even during the dot-com bust and the Lehman crisis, stocks did not fall this quickly. In less than a month, we've seen major indices fall almost 30%, and stocks in sectors such as oil and travel down by 80%. We're experiencing terrifying daily declines not seen since the 1929 stock market crash that preceded the Great Depression. We are at a watershed moment. This illness is a catalyst, fast bringing many long-simmering problems to the boil. It's exposing the creaking financial systems around us, and it will change the way economies function. Economic and financial pundits, however, have been focusing almost exclusively on the short-term effects of this illness, and so are missing the much larger themes at play. Epidemiologists tell us that when it comes to this virus, we're looking at a once-in-a-century event. It's highly contagious and highly lethal. Experts are not comparing this illness to SARS or swine flu, but to the Spanish influenza of 1918 that killed between 50 and 100 million people worldwide. We do not have good data on what the stock market did during the 1918 flu, but we do know that it led to a severe recession. The connection between influenza and recessions is well documented, going as far back as the Russian flu in 1889-1890, the Spanish flu in 1918, the Asian flu in 1957-1958, and the Hong Kong flu of 1968-1969. They all led to recessions. This one will be no different. Those were the words of Jonathan Tepper today, the founder of Variant Perception, a macroeconomic research group. At the end of this week, both the states of California and New York are now on indefinite lockdowns as the growth of this illness within the United States is moving faster than many people thought was possible. Hello, this is James Anderson speaking on behalf of SDBullion.com. This week, the S&P 500 fell 15% in its biggest weekly drop since October 2008. U.S. stocks are now nominally valued at their lowest level in 3 years of time. Let's get a longer-term perspective of where we currently are in this stock bear market with Scott Minerd, a public silver bullion bull since $35 an ounce back in the year 2012. A bond-trading billionaire who likely understands the endgame this financial system leads to revaluations higher for precious things.
Yeah, and I want to show our viewers right now a long-term chart of the S&P 500, our graphics crew. Everybody's just been working hard, and a shout-out to them for just getting really anything done these days, and it's been great. This is a chart, Scott, I don't know if you could see it. It's going back to basically 100 years ago. Comes from Bespoke Investment Group. Shows big drawdowns on the S&P 500. 49% in 2000, 56% in 08. We're down about 30% now. Is that one of the things you're looking at to say there's likely more downside in equities?
Absolutely. I mean, let's assume this isn't as bad as the financial crisis. That's a big assumption. But look at the drawdown that you got back in during the 2001 2002 recession, 49%. Back in 74, 48%. We're only down, like I say, a little bit over 30% at this point. So, we don't even have to get to financial crisis levels. But, Brian, to be honest with you, there's a good reason to believe this is potentially worse than the financial crisis. And, at this stage of the game, we probably should be having a little more caution in our approach and making sure we're getting investments that pay you to take on the risk.
State-level anecdotes point to an unprecedented surge in layoffs this week. The state of Ohio alone is ignoring President Trump's plea to not report jobless claims. They're reporting daily. Last week, 4,815 filed for unemployment insurance. But Sunday through yesterday, Thursday of this week, 139,468 filed for unemployment. That's one of 50 states. Perhaps we may see as high as 3 million unemployments filed once the data fully filters in. Calls for losing about 1/4 of the nation's GDP, or gross domestic product, this quarter are also making the commercial bank research rounds this week. Threats of potential financial terror are now yielding bailouts of almost anything and anyone globally. We are now back nearing fall 2008 levels in terms of government and central bank market interventions. Late last week, we ended our market update wondering what U.S. Treasury Secretary Steve Mnuchin meant by providing unlimited liquidity to the financial markets. Now we are starting to see trillions of commitments by this administration and other financial authorities around the world. Here are just some of the headlines from this week regarding escalating overnight repo loans. And here are some of the primary dealer banks who may be involved in this festering and financially troubling situation. This headline should remind bondholders that they may want to look back to the post-World War II high debt level era to see who took the largest haircuts back then, as inflation melted away much of the battle-accrued debts. The private Federal Reserve has not had time to update its Fed balance sheet charts, but this data here shows that they are actively taking more items onto their books. Here's how their Fed chart will look by the time they get around to updating it. With this current dire economic situation, we'll likely see their balance sheet more than double in the years to come. Word out of the Royal Canadian Mint this week is their bullion production facility and entire staff will be taking a minimum 2-week hiatus for their personal safety. As you likely well know by now, the physical precious metal bullion industry is lacking in bullion supplies, all while demand remains at very high levels. This current silver bullion product shortage situation has now bled over into vanishing platinum and gold bullion supplies as well. The COMEX-driven supposed spot prices for gold and silver continue to reflect a not since the 1930s Great Depression high of nearly 120 gold-silver ratio at the moment. Yet there remains virtually nowhere in the world where you can trade 1 ounce of gold bullion for 120 ounces of silver bullion, or an ounce of gold bullion for almost 2.5 ounces of platinum bullion. The best free market data we have on the American Gold Eagle versus American Silver Eagle coin sales ratio is currently showing a gold-silver ratio of roughly 83 at the moment. And while there may be about a year and a half worth of annual Indian silver import volumes sitting in the COMEX warehouse at the moment, it's hard to say at what price much of the lighter green pile will convert to the darker green and possibly get withdrawn from that leveraged, fractional reserved, supposed price discovery process. Other questions come to mind, like who would even be able to work and actually have the immediate capacity converting those non-homogeneous 1,000 ounce silver bars into silver bullion products investors and dealers would like to have on hand today. Next week we'll be back to talk about the ongoing ramping fiat currency fueled bailouts, and we'll see if this market bounces or if it will just continue devaluing the gold bullion as this trend looks set for the decade unfolding. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on. Have a great day and be safe out there.